Hello options traders. Well, I recently posted a video on ETFs and ETNs, but I wanted to do a follow-on video talking about the risk of these levered funds. And I know a lot of times traders use these as their base investments, whether they're using options or not, and they'll say, yeah, I understand the risks, either doubling or tripling the leverage, but the risk is far more than that. And most traders don't understand the true risk that they're holding when they have these levered ETFs or ETNs. So let's take a little closer look at the risks that these funds pose. So I'm just going to stick with the levered ETFs for this video, but the same argument applies to the ETNs. But most of you know that in the levered ETFs arena, there's generally 2x and 3x versions. There are others, but all this means is that it's a multiplier for the returns. So let's say that we have a levered fund on a particular index, and this index is up 1% at the end of the day. Well, the 2x fund will be up double that, or 2%, and the 3x fund will be up 3 times that, or 3%. And yes, as we all know, leverage is a double-edged sword. So that means if the index is down 1%, your 2x fund is going to lose 2%, and your 3x fund will lose 3%. Now, again, most traders think that this is all the risk that there is in these ETFs, that you're either doubling or tripling your returns. That's not true. There's a much bigger hidden risk. There are also what are called inverse levered ETFs, and they just move in the opposite direction. This would be a little bit like playing the put options. So if we have our indexes up 1% and you had an inverse 2x fund, you're going to be down 2%. Index is up, this fund is down, but to the tune of 2 times. Your 3x fund would be down 3%. Sometimes traders look at this and say, well, why would you ever buy this fund? Well, it's obviously because you're bearish. If the index goes down 1%, now you're going to profit. If you have the 2x fund, you'll actually be up 2%, and with the 3x fund, you'll be up 3%. So regardless of which flavor you're using, a standard fund or an inverse fund, you're going to run into the same problems. So what are they? Well, let's start with problem number 1. Regardless of what you're holding, whether it's a levered fund, mutual fund, just plain old shares of stock, it doesn't matter. Volatility erodes your returns. So what I mean by that is, let's say that the stock rises 10% and then falls 10% in the same day. That stock is not going to be back at zero. You're going to actually be down 1%. So sometimes I know it throws traders, it looks a little funny to say it rose and fell by the same amount. Shouldn't we be back to our starting point? Well, if we start with a $100 stock and we increase it by 10%, that's the same as right here multiplying it by 1.10, the stock would be 110. If I then take my $110 stock and subtract 10%, which is the same thing as multiplying by 0.9, we're just keeping 90% of that value, we end up with 99. And the order doesn't matter. I could have made the stock fall first and then rise. The point is that the stock will be trading for $99. So it also doesn't matter if the stock rose and fell 10% during the trading day or across time. Maybe it rose 10% on Monday and fell 10% on Tuesday. Same thing. You're going to have a $99 stock. At this point, we haven't even considered the leverage. So watch what happens, though, when we start dealing with levered funds. So this brings in problem number 2. The levered funds have a compounding force or a compounding effect behind them. You see, what you have to understand is that when they create these levered funds, those mirrors, that 2x and 3x mirror, those numbers are only good for the day. So if the index is up 1% on Monday, then yes, your 2x fund will be up 2%, the 3x fund will be up 3% on Monday. But you have to remember that your base is now changing. So you're not really resetting that every single day to the same value. Instead, you're just going to continue compounding those forces. So it turns out that the more the volatility or the longer you hold, the more the errors are magnified. So here are some questions. Let's say that the index rises 1% and falls 1% every single day. At the end of the year, mathematically, that would make it down 3.5%. We'll look at an example in just a little bit. So one question is, how much is the 2x fund down? and how much is the 3X fund down? Now most of you would answer the 2X fund would be down 7% and the 3X fund would be down 10.5%. That is absolutely wrong, not even close. The 2X fund is going to be down about 13.4% and the 3X fund is going to be down 27.7% or nearly 28%. Notice that if you guessed 7% right here, the true answer is really doubled again. It's closer to 14% or twice what you thought it was. And if you guessed 10.5% for the 3X fund, the answer is closer to 3 times worse than that. This is the compounding force. So where is this coming from? Well, normally I don't like to get into the math because it just scares people, and for the most part it's usually not necessary, but it's interesting to see where it's coming from. So let's say that we have the index rise 1%. Again, that's the same as saying 1 plus 0.01 that we're going to multiply by. And then we're going to make it fall by 1%, which is the same as multiplying by 0.99 or 1 minus 0.01. So what's really happening here is that for any given day, we are multiplying by 1.01 and multiplying by 0.99. That's what you're looking at here. So you might remember from basic math, if you want to figure this out here, to factor it out, we have to do the first terms, multiply those out, we get 1. We have to do the outer terms, we get minus 0.01. We have to multiply the inner terms, which is plus 0.01. And then we have to multiply the outer terms, which is minus 0.01 squared. These terms right here in the middle, minus 0.01 and plus 0.01, just cancel out. So we're left with 1 minus 0.01 squared. Here is the culprit right here. You're not just decreasing by 2 or 3 times, whatever that levered fund is, you're doing it by the square. Those errors are compounding. Now it turns out this isn't 100% true across the board. If we kept going with this, we'd find out there are some other factors that are going to offset it. But for the most part, this is the key culprit. So let's go back to the answer. If the index is down 3.5% at the end of the year, how much is the 2X fund down? Well, you should say it's closer to 2 squared the amount, or 4 times 3.5%, or about 13.4% is what it actually works out to be. How much is the 3X fund down? Don't say 3 times. It's more like 3 squared the amount, or 9 times 3.5%, or the actual numbers would be 27.7%. So let's go over to an Excel spreadsheet and see how this works out. So here's an Excel spreadsheet that I created, and it's pretty simple to follow. These are just the number of trading days. So I'm going to count by 5, 0, 5, 10, and so on. I'm going to start my stock at $1, and I'm going to increase that stock or that mutual fund by 1% and then decrease it by 1% in the same day. So the 2X fund is going to increase by 2% and down 2%, and the 3X fund will go up and down by 3 times that. So after 0 days, the stock is worth $1, regardless of which we're holding, whether it's the stock, the 2X fund, or the 3X. But notice after 5 days, volatility, as we talked about in the video, has started to erode some of this fund's value. It's not because of leverage, it's just because of volatility. It's down 0.05%. But the 2X fund is down 0.2%, about 4 times that. And the 3X fund here in green is down 0.45%, or almost 9 times that. And that's what we're seeing over here in the 2X fund, down about 4 times. The 3X fund is actually down about 9 times the amount. So you can see that these factors right here stay fairly constant. They will eventually start to get reduced the bigger the volatility numbers, mostly because you're starting to lose most of your money. But now let's see how this works out after the course of a year. So we're going to come down here to 360 days. The fund is down 3.5%. This is what we saw in the video. But take a look at the 2X fund, down 13.4%, and the 3X fund down 27.7, or almost 28%. Now you might think if we doubled the volatility to 2%, that the index should be down 7%. But you'd fall right into the same trap. Watch this. Let's make this 0.02. It's not going to be down 7%. Now it's down almost 14%. It's always falling by the square of that. Our 2x fund down 44%, and our 3x fund down 72.7, almost 73%. So while it's likely that you might be able to sustain a 13% loss over here, you're probably not going to feel the same about a 73% loss in that 3x fund. So this is the big risk. Now also graphically, the bigger the volatility, the more you'll start to see these funds start to level off. So watch if I make this, let's say 0.03% per day. See, in that 3x fund, you're going to start losing the majority of your money. Here, you're almost down 100% after about 300 days. So it's going to start to level off. And that's one reason for understanding why these factors won't stay the same. If we go to 5%, now you can see that that 3x fund, you're going to bottom out close to maybe 120 days. But for fairly small levels of volatility, you still get compounding errors over time. And that is the key thing to understand. So what's the moral of the story? If you're trading levered ETFs, use your options and keep your positions hedged. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.